We're certainly stretched. I mean, it could always go further. It could always go further into overdrive, and I think that's what the Fed wants. So it's not a crazy bet, but we are more cautious right now. I agree with Jeff's comments 100%. Valuations are very stretched, and if yields continue to go up, I mean, we've heard for a year now that higher valuations are justified because yields have declined so much. If yields go up, just intellectual honesty says the valuation multiples have to come down. 2018 is a great example. We had great economic growth. Earnings were up 20%, but the multiple contracted 26%. So the market was down. We can easily see a repeat of that in 2021.
So, Michael Farr, this raises a great question. Yes, if rates continue to go up, you're going to have a conversation about compressing of multiples. And some of those growth stocks may face a reckoning as a result of that. On the other side of the coin, though, let's not get overly crazy about where rates are, okay? They're still low. There's still a lot of money sloshing around in the system from the Fed and otherwise, and you could be looking at a big stimulus package, infrastructure under a President Biden, and money needs to go somewhere. So mix that with the warnings from some others about valuation of the market.
Right. Well, Scott, this is why this is such a thorny issue for investors, because Gundlach's right, and others are talking about how bubbly this market feels. Doug Cass has been writing about it a lot more lately as well. You've got very high valuations that were driven and have been driven by a whole lot of monetary stimulus and low rates. And look what we're getting. More monetary stimulus and more low rates. I mean, you got Janet Yellen and Nancy Pelosi and Jay Powell elbowing each other out of the way to pour more punch in the punch bowl right now. So they're not wrong. The market's expensive or stocks are expensive. But the jet fuel that has been lifting these prices doesn't show signs of stopping. So now as an investor, what do you buy and how do you deploy money? And the answer is, to be funny about it, is just very damn carefully. But I think it does argue against buying a broad index, and it does, I think, make it a much tougher environment, but an important environment to be a stock picker, to do the fundamental research, to know what you own, because it's this thing, I think, can get a lot more expensive. Trends on Wall Street last a lot longer than anybody ever thinks they're gonna. It looks like the path of least resistance here is still up.
Yeah. Steph, you weigh in on what Gundlach has said and what some of the others are talking about now about valuation. You're leaning pretty heavy, and Steph's on the phone, by the way, until we're able to work on her feed. This idea of leaning into cyclicals, which you seem to be doing a little bit more, that you're overweight that area. Yes, you have a barbell approach, but maybe you've put a little bit more weight on one end of the bar now.
Yeah, and I'm sorry about the connection, but I think you have to just step back, and I think you have to say, why are rates rising? Rates are rising because it's anticipating better growth because of the more fiscal stimulus, and that is coming. And when you combine that with improvement in distributions of vaccines, and we have a long way to go on that front, but when you combine the two, that means you're going to see better GDP growth, you're going to see better earnings growth, and to your point about stretched stocks, growth is stretched. Housing stocks are stretched. Logistics stocks are stretched. But cyclicals are not stretched.
I don't know.
And I don't think they are. I mean, look at financials.
Are small caps stretched? Are small caps stretched? I mean, that was one of the points that Gundlach was making yesterday as he was talking about what the Russell has done, and it's a point he's going to make today, or maybe he's currently making it now on his webcast. Are they stretched?
Well, I'm not an investor in small cap, but they certainly have had a nice run in recovery. But I'm talking about financials. Most of the banks are trading below book. Some of the industrials are definitely at trough earnings, and so they have a lot of upside. How about the reopening names? How about the restaurants? And we talk about Marriott and Wynn all the time because those are the two reopening travel leisure companies that I own. Those aren't stretched. They certainly had a nice recovery back, but they're still down quite a bit in the last year. So I'm looking for laggards. And to your point earlier, yes, I still have a barbell, but I have less of a barbell because I think it's prudent to take profit, especially when I can't justify some of the valuations.